In the last part of this series of videos, we're going to go ahead and delve into the welfare effects of trade a little bit more. So economists generally tend to be much more positive about trade and international trade than the general public. And I think that's because economists look back and say, well, countries wouldn't trade unless they expected it to be beneficial, because everyone has the option of simply walking away. They have the option of going back to just producing for themselves, and Japan has the opportunity to get its wheat by getting 5 wheat by giving up one computer. And so if the US offers it something worse than that, Japan can take its ball and go home. So almost by definition, if Japan is agreeing to the trade, it must be made better off. And likewise for the US. And to sort of notice in a sidebar here, notice that trade essentially creates benefits because of the differences in diversity. There's not much gain to be had from trading with someone who's a lot like you. Trading with your clone essentially would not be beneficial because your capabilities and abilities and opportunity costs would be exactly the same. I think that's a little bit opposite to the way most people look at trade. Most people might say, gee, trading with Canada, that's going to be mutually beneficial, but trading with Mexico, I don't know, we should worry about that. Okay. And most economists essentially, I think, would say that trade, international trade, is a way of coordinating the global production of goods across diverse countries. And essentially, because every country can take its ball and go home, it's voluntary and we expect it to be mutually beneficial. And it has the benefit here of not requiring any central coordinating authority that's going to require every national government to be subordinate to it, which would be a little bit of a pie in the sky that we could not accomplish here. I think less rosily, economists would also agree that although we can be relatively sure that trade is mutually beneficial, there's no guarantee at all that the gains from trade are divided evenly or fairly. The question of the division of the gains from trade comes down to essentially what the terms of trade are. And the closer the terms of trade are to a country's domestic opportunity costs, the less gain it will get from the trade. So essentially, you could sort of look at the US case here and remember that the opportunity cost for the US of one computer is 10 wheat. The opportunity cost for Japan of one computer is 5 wheat. The US can't really hope to pay less than 5 wheat per computer because Japan will take its ball and go home if the US offers less than 5 wheat per computer. But if the US can get Japan to accept only 6 wheat per computer, then that is a lot better for the US than having to give up 10 wheat per computer, as it would if it were rearranging its own domestic labor supply. So the closer the terms of trade are to that 5 wheat per computer, the larger the share of the gains that will go to the US. On the other hand, for Japan, Japan knows that it can't demand more than 10 wheat for each of its computers, because if it tries to get the US to pay more than 10 wheat per computer, the US will take its ball and go home. Japan could hope to get maybe 9 wheat per computer, and if it were able to do that, it would go ahead and get a larger share of the gains from trade than the US would. So notice that there's a kind of bargaining over the terms of trade. So the trade is going to be mutually beneficial, but we don't know how the benefits are going to be divided. And so there's both a cooperative element that countries are coming together to create mutual benefits, but also a competitive element because countries have some disagreement over how the benefits should be divided. we'll see eventually here that a lot of this will be sidestepped when we come to competitive markets. That essentially, a competitive market, there will be one price that is in some sense maximizing the gains from trade, and it will sort of eliminate a lot of this bargaining. A second thing we might see here, to sort of add some wrinkles here and explain why the general public is maybe less enthusiastic about trade, or perhaps even downright hostile to trade compared to economists, is that the benefits of trade aren't distributed evenly within countries. So far in this example, we've treated US and Japan as if they were single units, as if everybody within those countries shared equally in all the goods that are produced and consumed. And pretty clearly that isn't the case. Pretty clearly, the trade is going to redistribute economic welfare within each country. Japanese wheat farmers are not going to be happy about all this cheap American wheat coming into the Japanese market. So they're going to be made worse off. The Japanese computer exporters are going to be happy because they're going to gain business, or they're going to be able to get more wheat per computer than they otherwise would. And consumers or businesses who use imported goods are also going to benefit. So if we thought about, say, for instance, steel and the steel trade, US steel producers are going to be typically not happy about steel being shipped from China, say, for instance, to the US. They're going to be hurt by that. And that's, people are going to have lower wages, or there are going to be fewer jobs in that industry because of those Chinese steel exports. On the other hand, US exporters are going to win. So Boeing, say for instance, if it sells aircraft to China, people are going to have higher incomes in China because they're exporting steel to the US. They're going to fly on planes more. Boeing's going to sell more airplanes, and Boeing and its workers are going to be made better off. Consumers, people who buy products made from steel, are going to benefit from the cheaper Chinese steel. And businesses who use steel are going to be made better off. So something like an automaker is going to be happy about the fact that there's imported Chinese steel. And US automakers and their workers are going to be made better off by those cheaper input prices. When we go out and study these things, what we typically see here is that the total benefits to groups B and C are typically about 3 or 4 times the costs that are inflicted on group A. So if we were thinking about something like sweat socks, and someone's making $30,000 a year producing sweat socks, well, allowing cheap sweat socks to be imported from Haiti or Honduras or wherever out there might create $100,000 worth of benefits out there in the economy for groups B and C, but someone else has lost their job. I mean, people do lose their jobs because of trade, and it's pretty silly to pretend that people don't. What we tend to see out there is that it's often a situation where one person takes a huge loss, and that person, there's no doubt that what happened to them was due to trade, and it's concentrated all in one person. And then there might be 100,000 people who are $1 better off. And so what often happens is that people are not really even aware that they're benefiting from cheaper socks. But notice that if the gains are exceeding the losses, these people could give up $30,000 or maybe even $32,000 or $40,000 and give it to this person. So if the people who benefit give some of their benefits to the people who are hurt, then they're both better off. So these people, say for instance, give up $40,000. That leaves them with $60,000 net benefit from the trade. This person loses their job, but then they get a check for $40,000 a year, so they're better off. So economists are pretty confident that trade does create gains, and pretty confident that there is at least the potential to compensate the losers and truly make the trade beneficial for everyone. Notice the fact that trade creates gains is not something that is alone to trade. Lots of economic changes out there create winners and losers. So new technologies are going to create winners and losers, changes in tastes, all sorts of things out there. When one business is more successful at making a quality product than another, that's great for the business that makes a great product, but it's kind of bad for the business that doesn't, and it's bad for the workers in the business that's not making a competitive product. So we're going to have winners and losers in any situation where we have economic change. And what we should do about that, I think, is an important question. We could forbid or slow down change. And maybe that would be something we find attractive. Change is painful. People don't like change. And if we forbid or slow down change, then we'll have less pain from that change. We will then also have fewer of the benefits of change. So we'll have a slower rate of growth. Maybe we don't want to have new efficient solar panels because we want to make sure that coal miners don't lose their jobs. We could go that route. We could try and compensate the losers, as in my earlier example out there. This sort of raises the question of what types of change do we think that people deserve compensation for? I think relatively few of us would say that if Microsoft makes a bad mobile phone and it loses business to Apple's superior mobile phone, that we should compensate Microsoft for the fact that it made a shoddy product. And I think, that would be a tricky argument to make for most people. Likewise, maybe a little bit more sympathetic, but, if people start smoking less, should we compensate tobacco farmers for the fact that tobacco prices have gone down? Well, we might think that, or we might not. Notice also that if we do something like that, we're going to go ahead and weaken incentives. So ideally, we would want tobacco farmers to be looking ahead and sort of going, it looks like tobacco prices are going down, the demand for tobacco is going down. Should I invest in some new tobacco machinery? Well, no, maybe I shouldn't. Maybe I should start thinking about farming something else. If people know that they're going to be compensated for their losses, they won't have that incentive to look forward and try and concentrate on what the actual needs are going to be in the near future. And in fact, people may sort of deliberately stay in fields that are likely to go under because they know that they'll be compensated. We might sort of say, well, let's just make sure that, generally speaking, we have an adequate social safety net. Now, there's some incentive effects on this, but we're not going to go ahead and perpetuate people staying in industries that are in decline. And then finally, we might go, you know what? Most changes out there are benefiting me. Some may hurt me, but on net, 90 of the 100 changes going on in the economy might benefit me, 10 of them will hurt me. So on net, I'm going to be benefited. And we might just sort of go, well, we can't totally ensure that everyone is always always helped by everything. But on net, we're pretty confident that people will be helped. So doing nothing is always an option. I think if you were to go out there and poll economists, I think they would be pretty united that we should be concentrating on options 3 and 4 here. But realize that we do sometimes, as a matter of public policy, have number 2 here. That we do sometimes set up policies that are designed to compensate losers for specific types of change. And you can ask your poli-sci professor why we compensate people for some types of change but not for others.